Hey, welcome everyone. Good afternoon. For our fifth market update webinar, this is the fifth week in a row that we're getting some timely information and education out to all of you. Hopefully everyone is doing well, hanging in there. Hopefully we see a end in sight here. Again, we'll have some content that we'll get through. Probably 20 minutes or so. Brian is going to walk down the agenda, but we really want to do this for you. So the question and answers, we'll answer all of your questions that you throw out. So just make sure you ask any questions that you have. Again, speaking is Joe Anderson, Certified Financial Planner, President here at Pure. Brian Perry, he's our Executive VP, Director of Research, CFA, CFP, AIF. He's got all the credentials needed to speak on behalf of us here today. So again, with all the information that we are sending out to you, just go to the front page of our website, COVID-19 responses. Brian actually just wrote an ebook in regards to COVID-19. So after this, if you guys want a copy of that, we can get that out to you within the replay. So just reach out to us if you would like a copy of that ebook. It's about 50 pages. It's really well written. Just kind of gives you a backdrop of what's been going on. And then some of the stimulus program that the government is kicking out, and probably stay tuned because there's probably going to be a lot more of that down the road. So what the agenda is today is Brian is going to talk a little bit about, is the CARES Act really helping the economy yet? Are we seeing any effects of the economy reacting in regards to the big stimulus? And then we can put the recent market rally into perspective. I think today we're up another 500 points, breached the 24,000 mark roughly on the Dow Jones. So what does this mean? Does this mean that, we found bottom and, the coast is clear and, we'll gradually see some increases, or can the bottom fall out again? So we'll put this in perspective just to kind of keep you in the right frame of mind. And then we can kind of take a look at all types of bear markets. This is an interesting bear market that we're in right now, and so we can kind of give you some perspective on that. And then we'll end the webinar with some question and answers. We want to keep this short and sweet, 30 minutes, 45 at the most. So Andy's on the line as well, Andy Last. And so if you want to just type in any questions that you might have, feel free to type it in there. And then at the end, we'll just make sure that we can do some rapid fire and answer those questions. So, Brian, I guess the question to you is the CARE Act, really helping the economy?
Yeah, thanks, Joe. And good to be here again. And I think we should keep doing these because every time we do, I feel like the stocks do pretty well. And we'll get to that in a little bit. A little bit soon for the CARES Act really to have too much of an impact, but we are starting to see some of the checks are about to go out. We're starting to see some of the small business loans going out, so hopefully some support for the economy coming soon. But taking a look kind of where we're at in the economy, this chart shows you gross domestic product, GDP, for the last several years, and speaks to an economy that was not going gangbusters, but also was not declining, right? We had one weak quarter at the end of 2018, but otherwise 2 to 3% growth, which is pretty much quote unquote normal for the economy. And so that's the backdrop we were in as we headed into the coronavirus. We're also in an environment where looking at initial jobless claims, they're down around 200,000 per month, per week, going through the first part of 2020. And then, wow, 3.3 million jobless claims there in mid to late March. That 3.3 million was 5 times higher than the previous record. So the most initial jobless claims in a week in history. And then the last 2 weeks have been more than twice that much. So in very short order, almost 20 million people unemployed. And that's really what happens when the economy shuts down. And large swaths of the economy have effectively closed. Not many businesses in the past have modeled out what their business model would look like if revenue dropped to zero, but that's what's happened in a lot of cases. Important to remember, though, and Jamie Dimon, CEO of JP Morgan, pointed this out today, is that a lot of Americans are still going to work. You know, here at Pure, we're still at work. Hospitals, healthcare workers, public safety, still at work. Teachers still teaching via online delivery. A lot of people doing their jobs from home, food service workers, food stores, et cetera. So although jobless claims up quite a bit, and those are jarring numbers to see 20 million Americans out of work in such a hurry, that still leaves hundreds of millions of people that actually are still working. So let's take a look at the good, the bad, and the ugly. Believe it or not, there is actually some good from an economic perspective if we look out in the near future, and that includes lower oil prices. Now, granted, that only really helps when you can drive, and there's not a lot of reason to drive to a lot of places at this point. But once we get out and about and the summer driving season hopefully comes back into play, lower oil prices act effectively like a tax cut for the consumer. So the less you pay at the pump, the more discretionary income you have to spend on other things. We're also have seen interest rates come down quite a bit. And with that, mortgage rates have declined as well, which can be a stimulus to the economy. And then the government has stepped in with a lot of support. And we've talked about that some. We write about it in the ebook. But whether it's the CARES package, whether it's the Federal Reserve, there's been a lot of government support. Again, the government in and of itself can't get the economy moving forward, but they can put support underneath it until such time as activity gets back to normal. Unfortunately, along with the good, there is some bad. We've seen millions of people out of work, like I talked about, and that number expected to increase. I suspect that we'll continue to see that. Even if not at quite the same pace, we'll see the numbers of the unemployed continue to increase until such time as businesses reopen. And in some cases, a larger business probably okay, but smaller businesses can struggle to reopen. So there are going to be some businesses out there that may find that they never open their doors again, and that can lead to job losses and displacement and stuff. And, the key there, and with all of this, is how long until normal. Governor Newsom out today, along with a number of other politicians, we are beginning to see some talk about when the world will resume normalcy or begin to leg back into this. But it'll be a process. Exactly when it starts, we'll see. Probably not in the next week or two, but we'll see into May if restrictions on shelter in place and other stay-at-home orders start to ease. But it's going to be a while before we're back to fully normal functioning society. Exactly how long we go will determine exactly what the economy does. The ugly, and these are longer term concerns, would be, one is, what does COVID-19 mean for globalization? Globalization, although it has certainly issues, worldwide trade and free movement of people and goods has issues with inequality and some other things, has been on the whole a positive for economic growth as well as for prices. All else being equal, inflation is lower because of globalization. Something like COVID-19 could certainly slow that. And it would not be unthinkable for globalization to slow down. Prior to World War I, globalization was very robust. In fact, the world by a lot of measures was more globalized in the early part of the 20th century than it was in the 21st century. Yet World War I and what came after that stopped that. So certainly something like COVID-19, if companies bring supply chains back home, there's less overseas trade, overseas business, could be a longer term negative for the economy. How will industries evolve, right? There are entire industries out there that have evolving business models. Look at something like Zoom, which has become the go-to platform for a lot of people. Not nearly as popular 6 weeks ago as it is today. Maybe the gaming industry and some Netflix type things are more popular. Maybe there are other industries that may never come back. Maybe things that involve people gathering together. Some of those may come back, some may not. So industries, it's the nature of capitalism. They call it creative destruction. What businesses will thrive, what industries will thrive, and what will come out of what is surely going to be a point of demarcation, which is before and after COVID-19. And then what about the jobs that don't come back? And that's been a recurring theme for the last 20 or 30 years as globalization and the technology wave have displaced workers. And then you see a lot of them have trouble getting back into comparably paid and comparably skilled industries. What's going to happen for people that lose their jobs and they don't come back? The Conference Board has put out some economic forecasts, and this is a nonpartisan think tank that gathers a lot of information. And essentially, they put out 4 different possible scenarios for the economic recovery. And I think that this is pretty useful to look at. Which one comes to pass, we'll see. But they think about a May reboot, which is a quick recovery where you see a peak in new COVID-19 cases mid-April, so right around now. Economic recovery beginning in May, maybe restaurants, travel, and the like begin to ease restrictions. Even in this case, you still see annual GDP growth contract quite sharply, but obviously that's a best case scenario. Their second possible scenario is a summertime V-shape, which is where the similar scenario to the first one, where you've had the sharp drawdown, but the recovery gets postponed a little bit. and you see recovery begin in the summer. The third one would be a W shape, and this is a little bit frightening here, would be that you see a recovery where the world starts to go back to work and people start to come out of their homes here in early summer. But then come fall, come flu season, COVID-19 returns and shelter-in-place mechanisms have to come back. That's probably a worst case scenario where we get back to some sense of normalcy and then have to reverse that. In that scenario, you see a rather drastic decline in annual GDP growth of almost 7.5%. And then the last scenario, and perhaps they think the most likely, a U-shaped recovery where social distancing does help flatten the curve, and we're seeing some signs of that. But it also prompts economic weakness that doesn't recover quite as quickly as some of the more optimistic people might and forecasters might hope for. Economic weakness into the third quarter, and then a slower but more sustainable recovery. We'll see which one of those comes to pass, but we do want to caution that it's not a clear thing that just because shelter-in-place restrictions get eased, the economy will instantly snap back. Certainly, there might be a rush for people that have been trapped in their homes to go to the movies or go out to eat or something like that. But if you look out past that initial surge of activity, there are going to be a lot of people whose personal balance sheets might have been damaged. Somebody that was out of work or underemployed or saw their income drop for a period of time. Those people, again, they might celebrate the easing of shelter in place temporarily. But if you look out past a couple weeks or months as the world gets back to quote unquote normal, some of those people may rein in their spending a little bit as they try to repair their personal balance sheets and their equity in their portfolio and stuff like that. And that could have trickle down effects throughout the economy and extend out any eventual recovery. So this chart obviously has a lot going on, but I think it's pretty instructive in that it has a bunch of different countries from Argentina, Australia, on down to at the bottom of the right-hand side, the UK and the United States. Shaded in blue are times when the economy was not in technical recession, and shaded in red are times when the economy was in a technical recession, going back to 1960. And why I think this is instructive is a couple-fold. One is that you see a lot more blue than red. So obviously, most of the time, economies are growing. However, you see pretty consistent red as well, whether it's in the United States or these other countries. Recessions are part of the economic cycle, and each one's unique, each one's frightening. But I think this is a powerful reminder that although we periodically do get recessions in the U.S. economy, as well as various countries around the world, we've also always come out of them, and growth does return. You'll hear a lot of talk probably going forward about recessions. A lot of times people throw out the term that a recession is defined as 2 consecutive quarters of negative GDP growth. That is, in some senses, a technical definition, but in the United States, it's actually the National Bureau of Economic Research that dates recessions. And according to their website, they define a recession as, quote, a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. So the NBER, National Bureau of Economic Research, will eventually, if we are in a recession, which it seems very likely we are, date the recession to a starting date and an end date based on a variety of factors. But again, like this chart shows, a lot more blue than red, and over time, the economies have always recovered from recessions. And with that, I want to touch just on one of the opportunities that could potentially come out of this. When you look at gross domestic product, the economic activity in the economy, there's 2 components of that. One is growth in workers, so how many people are working. The other is how productive are those workers. And the sum of those 2 equals your growth in GDP. The gray bar on this chart is your productivity, your growth in output per worker. And as you can see, it's mostly been declining for the last 60 years. And in particular, in the last 30 years, it's been steadily moving lower. The reason I point that out is that a lot of times when you see something like what we're going through, whether it's a big upheaval in society, a challenge society faces in the past, it's often been a war, but certainly COVID-19 is effectively a war against a virus. A lot of times that's when you see the greatest ingenuity from human beings, when they really shine, when out of the challenges come unexpected development and jumps forward in productivity. And so I think that's one of the things to look for out of this, is that potentially we could see in areas we may not even be expecting productivity gains that lead to the next great business and drive the economy forward and hopefully improve people's lives. So the next thing that we want to do is we want to put this recent market rally in perspective, and it's been pretty strong. What we've seen is the S&P 500. If you look out over 10 years, despite the decline here in the last couple months, still up 2.5-fold in the last decade. A sharp drop from about 3,300 on the S&P 500 down to about 2,300. So a sharp decline, but we've had a pretty significant bounce as well. And you can see that more closely on the right-hand chart for the past 3 months. And, just to put it in context, this is pretty common in bear markets. And so I just want to caution everybody that just because stocks fell sharply, and in fact with unprecedented speed, and now we've had a very sharp rebound, doesn't mean that we're out of the woods yet. It's entirely possible, and again, I don't have a crystal ball, but it's entirely possible that stocks could resume their decline and maybe even go down to new lows or test the lows. Again, that may not happen if the economy recovers, we get back to work and the like, but it's very common. If you think even back to 2009, the stock market bottomed in March of 2009, but even before that, there were numerous times in which you saw temporary rallies followed by further declines, and volatility around the bottom is very common. And so although the last several weeks have been much more enjoyable for investors, I just want to caution that that doesn't mean that we're out of the woods. And I think whether we go up or down from here, you can expect continued volatility. Back in March, the volatility was to the downside and that we were falling sharply. Lately, we've had some really good up days, but I think we can count on volatility going forward. The one positive in the markets, and this is high yield bond spreads. And so the spread is just the additional compensation you get for buying a high yield or junk bond. So these are bonds issued by lower rated companies. The additional compensation you get for buying this, for lending money to a lower rated company as opposed to the US government where there's no credit risk. That additional compensation spiked as the fears of COVID-19 came into play and recently has declined. Why I think that's important is that the ability of companies to fund themselves is one of the most important things in the financial markets. And Jim Cramer, who I don't often cite, but was talking about this on CNBC today, is that when you look at 2008 versus now, one of the big differences is that in 2008, companies couldn't fund themselves. And now you're seeing companies can continue to borrow money. Even Carnival Cruises, just to pick a company, right? It may be a while before people want to go on a cruise ship, but they had a great business going back not too long ago. Their stock was down 85% from peak to trough in the course of a couple months until the last few days. Were able to raise billions of dollars. They sold some stock to Saudi Arabia. They sold some stock in the public market, and then they were able to issue some bonds as well. So really encouraging to see companies that are going through temporary stress still be able to access the capital markets. And then the final point on this recovery is just the most affected industries. And so if you looked at 2008, 2009, a lot of industries affected, but among the main ones were finance and construction. This time, and those companies in those industries made up a large component of both corporate earnings and also gross domestic product, wages, and the like. Now the industries most affected, hotels and tourism, airlines, entertainment, restaurants, food. Obviously important industries, they generate a ton of jobs. And for anybody that's out of work or suffering from this, certainly that's a terrible tragedy. But from an economic perspective and from an S&P 500 perspective, the actual contribution to earnings of those industries, the kinds of things that we go out to that we're not able to right now, only about 7% of operating earnings come from those industries. And from a corporate perspective and a stock market perspective, what that means is even if earnings fall off a cliff, which they have in a lot of these entertainment and travel and leisure industries, the impact on corporate America at the high level isn't quite as great as it has been in past recessions. The final thing we want to do here is just take a look at types of bear markets. And this was based on some research that Goldman Sachs put out. And what they did was they identified 3 different kinds of bear markets, and they broke them down into structural, cyclical, and event-driven. And they defined structural bear markets as those that are prompted following some sort of financial imbalance or financial bubble. And classic example there would be 2008, 2009 from the housing boom and bust, as well as all the leverage in the financial system. Another example would be the early 2000s with the dot-com boom in the 90s and then the collapse there. Cyclical bear markets are more a function of the normal economic cycle. The economy grows, and then the Federal Reserve tightens interest rates to rein in growth and inflation, prompting a recession and or a bear market. And then event-driven are more from an external event. So maybe that's a terrorist event or some sort of a flash crash or something like that. And I think that by most reasonable assumptions would be that right now what we're going through is an event-driven bear market. The COVID-19 was completely external to the financial markets. It came about, and you saw the market quickly enter into a bear market. And what's interesting here are some of the statistics where obviously structural bear markets much nastier than the other type, with an average decline, if you look back in the last 130 years, of about 57%, lasting 42 months and taking 112 months to get back, or 111 months to get back to the starting point. Cyclical bear markets and event-driven bear markets, average declines are very similar, 29, 31%. The big difference there is how long it takes you to recover, with event-driven bear markets lasting 9 months and a relatively quick recovery, whereas cyclical bear markets get drawn out a little bit. I think the question here with what we've gone through is whether it stays as an event-driven bear market or morphs into where the overall economy prompts a cyclical bear market. One important point that I want to make, and I'll end with this, and then we'll open it up to any questions that you might have, is looking at the economy is not going to tell you where the stock market's going to go next. And I think that that's an important point to just reemphasize. Stock markets are forward-looking. And so the fact that stocks fell in February into March 30, 35% was in anticipation of an economic slowdown. The stock market knew that people were stuck at home, that the economy wasn't going to grow, that we'd likely go into a recession. And so it ran ahead of that and fell. Just because we're maybe in a recession now and there may be an avalanche of bad economic news coming over the next weeks and months doesn't mean stocks will continue to fall. Stocks are going to move based on whether the news is better or worse than expected. So even if we slide into a recession, even if corporate profits are weak, if they're not worse than expected, stocks could do just fine. Conversely, if the news is worse than expected, that's when you would see stocks resume their decline. With that, I'm going to kick it back to Joe.
All right. Thanks, Brian. If you have questions, please feel free to jot them down and ask any question that you have, and we'll stick around and answer questions that come through. So, Andy, do we have any questions?
We do, and just as a reminder, all you have to do is click the Q&A button at the bottom of your screen and type in your question, and we will get to it right here. First one is, I just received my CARES rebate. What is the impact of the rebate on my 2020 tax return? Is it additional income?
Well, congratulations. Checks are coming. Yeah, we got notification from another client that got their SBA loan or their advancement of around $10K there. So we're starting to see some of the checks trickle in. And no, it's a tax credit based on your 2020 tax return is basically what it is. So how it works is that they took a look at your 2018 or 2019 adjusted gross income. So if you're married, the AGI needed to be $150,000 or less before they started phasing you out. And if you're single, it's $75,000. So any dollars over those thresholds, so any $1,000, they would reduce the overall credit by $50. So I'm not sure what tax return you have on file. So they look at 2018, they look at 2019. So if you didn't file 2019, they looked at 2018. If you qualified, you got the check. So what happens is that nothing. It's a tax credit. It's cash. Spend it, save it, do whatever that you want with it. It's not going to show up as income because it's really basically a tax credit on your 2020 return. So how they're looking at it is that they could have waited till 2020, but we need the cash today. So they just kind of put it in advancement, for lack of a better term. So for those of you that didn't qualify from your 2018 or your 2019 tax return, you could still qualify on your 2020 return. Because how they did it was kind of, I guess, I don't know, not as effective or efficient as it could have been, because most people probably wouldn't qualify in 2018 or 2019 that qualified today. As you look at how many millions of people are filing unemployment, that their income in 2020 is probably going to be lower than it was in 2018 or 2019, and they would probably qualify for that tax credit this year. They're not going to receive a check if their incomes were higher than the thresholds, but they will receive a tax credit for 2020. So congratulations that you got the check. No, it will not be income. So hopefully more and more checks will start funneling through. So,
and the next question is, are markets traditionally good in election years? What do you think will happen this year?
Wow, that's an interesting question just because I think the election was the dominant topic, right, Joe, until just recently, and then COVID-19 kind of swamped that. The research is mixed. In a lot of times elections are just like everything else, right? Sometimes it's good, sometimes it's bad. One of the things that we had seen was that markets were very worried about, and this has kind of flown under the radar a little bit because of COVID-19, but markets were very worried about Bernie Sanders as president. and some of the policies that he might enact. And you saw as his popularity kind of peaked over the winter, some ripples in the financial markets. And now that he's withdrawn from the election, I think that longer term, at least from a stock market perspective, that's probably a positive. And then going forward, I think the one thing to keep in mind is political affiliations a lot of times drive people's views of the economy and the markets. And so there's some charts, and we could put them up next time. But basically, if you look at following the last election, the view of Republicans on how the economy was doing skyrocketed while the view of Democrats plummeted. And the result was probably somewhere in the middle. So it's really important in election years to kind of, it's great to have an opinion on the politics, but to separate that from what's actually going on in the economy and the financial markets.
Next question.
Sorry about that. Next question is, the national debt is likely to skyrocket with the CARES Act and other legislation to address the economic challenges due to COVID. What are the long-term impacts of this on investors and U.S. citizens at large?
Yeah, I mean, I think that's probably a true statement. I think right now we're in a crisis, right? And it's like at the emergency room, you triage, you do whatever you need to keep the patient alive, and you worry about the longer term consequences later. And so I wouldn't worry unduly about the national debt at this point. I think the more economic stimulus the government can put out, the better, and we'll figure out how to pay for it later. Further out, yeah, I mean, I think that the national debt probably is an issue. And one of the problems is not the national debt we're accumulating now, but the national debt we accumulated in the last decade when the economy was doing pretty well. Keep in mind, though, that there's two facets to it. There's the amount of the debt and there's the interest rate you pay. And although the debt itself has skyrocketed, the actual interest rate that the government is paying has plummeted as interest rates have gone down. And so the debt servicing cost, or the share of government revenues that's going to pay the debt, actually hasn't increased, even though the debt has. So that's important to focus on. Longer term, I would say that, there's a couple ways to get out of a large debt load. You can grow your way out. So if the economy grows, if we find a new source of productivity, you can default on your debt, which I don't think the U.S. is going to do, but that's one way. You can inflate your way out, so you can have higher inflation so that you pay back the debt with dollars that aren't worth as much. Or you could tax your way out, right? You could raise taxes. And Joe, that's something that we're certainly keeping an eye on.
Yeah, I mean, I think, with the trillions of dollars going in, there'll definitely be adverse effects. And higher taxes could absolutely be one of them, higher inflation. So that's why just making sure that your plan is fluid, that you're taking a look at, all right, well, let's run different options. Let's run higher inflation. Let's run higher taxes. What is that going to do to the overall strategy? And what makes sense now? What planning opportunities do you have in front of you, knowing, we don't have a crystal ball. We have no idea what's going to happen. But if I were to bet, I would imagine that, tax rates will probably go up a little bit. They're already due to go up in 2025, but we'll see. So next question.
Next question is, do you know the schedule for the issue dates for care checks? And do you know what the max income level is to receive the $1,200 per person versus what are the amounts that are to be paid out for income levels that are higher?
I don't know. Alyssa was showing me something I was reading, so I totally ignored that question.
Did you want to hear it again?
Yes, please.
Do you know, first part of that question is, do you know the schedule for the issue dates for care checks?
The scheduled date for issue dates. No, they're trying to get them out as soon as possible. So
okay.
I would imagine over the next couple of weeks. I think we're already seeing some people get those checks deposited.
The next part of the question is, do you know what the max income level is to receive the $1,200 per person versus what are the amounts that are to be paid out for income levels that are higher?
Well, yeah, it would phase out depending on the $1,200 that you would receive as a single person. If that individual has kids, there's another $500 as long as those children are under the age of 17. It's on 17 and under, it's under the age of 17. So their phase outs would be different depending on how many children that they have. So for someone that doesn't have any children, it's so every $1,000 that is over the $75,000, $50 of the credit is reduced. So for an individual that has 3 children versus someone that an individual that has no children, their phase out is going to be completely different because they have a lot larger credit, and so it's that many more $1,000 over to take $50 off. But that's the math. So I'm not sure how many children, if any, that this person has, but they can do the math themselves if saying, all right, well, if my adjusted gross income is the start of the phase out is $75,000, so my credit is going to be reduced by $50 for every $1,000 over that number.
All right, next question. It seems as though the recent stock market recovery assumes a V-shaped recovery, which is a big assumption. Wanted to get your thoughts on this.
Yeah, we kind of went through that earlier, and that is a huge assumption, and I don't know if that's very likely at all. I think we're in the camp of probably a U versus a sharp recovery.
Yeah, agreed. I think we're probably too low. Again, this gets into forecasting, but we were probably too low at the bottoms there several weeks ago, and there was a lot of bad news baked in. And now with some of the recent moves, there's a lot of good news on the recovery baked in.
Yeah, and I just think, just being a human being, you're thinking how much is going to change. So we've been shelter in place now for 5 weeks or so here in California. And, just thinking about going to, a Padre game or an Angels game or, it's like almost out of the realm at this point. How many people are still going to be kind of freaked out and, not going on airplanes or even, restaurants, which was so much part of the norm, which I think a lot of people are really looking forward to. But then because of the length of this has changed perspective. So it's going to take a while, for us to get to any type of normalcy, if that's even a possibility. So next question.
As a reminder, if you do have any questions, just type them into the Q&A box there in Zoom, and we will get to them right away, because right now we don't have any others. We got somebody who said, I want to thank Joe and Brian for putting on these weekly conferences for us, along with the experts' presentations. It's very helpful.
Okay, well, cool. That's right on the 30-minute mark. That was kind of the goal for today. So hopefully you found this informative. We will continue to do these probably over the next week or two, just to keep you abreast of what's going on. And like I said, if you have any questions or comments, please feel free to reach out to us. We will send a replay out to everyone that was on the call, and then we'll send a copy of Brian's ebook as well, which is just retitled to something else, retirement reboot. Yeah. So, all right. Well, thank you very much, everyone, for joining us. And if though that was the question, we have to go through the legalese here. All right. Oh yeah. All right. Well, that's it. Have a wonderful day, everyone. We'll see you soon.